Yes.
Why are you muting? Felix, how are you? Felix.
Yes. Hi.
Mbona unapotea? Wewe ni wa Man U? Wewe jamaa
No.
Man U. Wewe ni wa Man U? Wewe jamaa wa
No.
Man U ndio wanajificha jificha leo.
Hatuwezi jificha.
Kashunga.
Hatujifichi.
Kashunga,
Yes.
how are you?
I'm good.
Na support timu gani?
Mimi si fan wa ball.
Lakini uliwatch marathon.
Hapana.
Okay. So you are good, right?
Yes.
I had another class in the morning. Out of 38 students, only 16 turned up. And the excuse was ni watu wa Man U. So I don't know why this class we have only 2. That's why I'm asking that question, Felix. We can start. They'll find us on the way, right?
Yes.
I have a meeting at 3. Yeah. Let me see the far that will have gone. Mute yourself, Felix. Mute yourself. So I want us to look at mergers and acquisition. I want you to mute yourself. We start. And we are still in the group accounts. It's a very wide topic. So I want us to look at the mergers and acquisition. You're watching my screen now?
Yes.
Yeah, we are talking about mergers and or acquisition. When a business acquires, that is Zuhura. Zuhura is saying she can, and me see. I'm informing you that I'll not be able to attend the class. Well, that is Zuhura. Yeah, we go on. I'm saying the definition of a merger. This is basically when 2 separate entities come together. But when we are talking of acquisition, I acquire you, you stop existing. You know, these words have been used interchangeably in Kenya. For example, just to digress, what was the kind of partnership between NIC and CBA? That's the latest. Is it an acquisition or a merger? Did CBA acquire NIC or they merged?
It's acquired. It was acquired.
It was acquired. But they were saying it is.
Yeah, they were.
But they were saying it was a merger.
I don't think so. They were going at less than the.
You see, Felix, okay, ideally, I get you where you're coming from, eh? But when I acquire you, if I acquire you, you stop existing. Yeah? But in Kenya, I'm saying the International Financial Reporting Standard 3 is not being followed to the letter. The other day, KCB acquired National Bank, but they still have to retain their name. So is that an acquisition or a merger? From the business definition,
That's a merger.
you see it's a merger, but they acquired them. When National Bank was put under liquidation, KCB expressed interest. They purchased it at 114.7 billion, but they have asked them to retain their name because of the cost involved in the rebranding and the like. Anyway, when you are talking of a merger, it's a
I have a question.
Yes.
I have a question. Now, what about the issue of ABSA and the Barclays?
You see, Barclays ceased to exist. Barclays was actually Barclays was acquired by ABSA. Barclays left the African market, and they had to dispose of their stake in the African market. So they were acquired by African Bank of South Africa. So that was an acquisition. That's why they ceased to exist. They had even given a deadline of how long ABSA should use their name before they brand themselves. Now that is a pure acquisition, right?
Thank you.
NIC and CBA is a merger, but KCB and National Bank is not a merger, it is an acquisition. But where now we are talking of a merger like NIC and CBA, of course, we are seeing that CBA is the dominant, is the dominated bank. So it's like they acquired NIC, but retain the N to have that outlook of purporting that they are merger. But we know they were acquired. You know, when two big families come together, great things happen. That's the Ndegwas and the Kenyatta family, right? It was a good deal. All the money that you get for Fuliza is coming from CBA. So they've again merged with Safaricom to be providing the Fuliza credit to their clients. That's a new way of doing business. So when we are talking of the merger, we are talking of a business combination that brings separate entities together. And when you are starting the group's accounts, we said, if I control more than 50% of your shareholding, then you become my subsidiary. If they are less than 50, but more than 20%, you are an associate. If we control equal 50-50, it is a joint venture. But if I control less than 20%, then you are my investment. So you should understand where we are coming from. So when we are talking of the merger, is bring the separate entities into one reporting entity. So only one entity will be reporting. And we are talking this because of the International Financial Reporting Standard 3, which have to be adopted strictly, even in the mode of the preparations of the final books of accounts. So for the business combinations, except now for combinations such as mutual entities, where we've agreed to act together, we have contract without exchange of ownership interest. These are like JVs. They are more or less like JVs, but there is no contract. And then we have the JVs. These are excluded from the IFRS 3. So the method that we do adopt for business combinations is the purchase method. Initially, we used to adopt the International Accounting Standard 22, where, and you can see now where the Kenyan market is. Under this method, or what we used to call the pooling method, the acquirer couldn't be identified. You could not tell who is owning who. Just like the way I've asked you between KCB and National Bank, who is the owner. Of course, the government controls the stake. So under the pooling of interest method, or what we call the merger accounting, no goodwill arises. We assume that there is no distinction between the post-acquisition and the pre-acquisition. Therefore, there is no any goodwill that is realized. And therefore, as we get or acquire that other entity, the acquisition is like a pathway. We don't revalue any goodwill. The International Financial Reporting Standard 3 recognizes goodwill at the acquisition. There should be a reason why I'm acquiring you. And one of the things is because it's a business interest. So there is no way I'll acquire you and you've not made, even the brand itself, even the brand penetration in itself is goodwill. So you have prohibited the use of the IAS 22. And right now, all the mergers and acquisition are supposed to adopt the IFRS 3. So even in the examination, without being told, don't go for the acquirers method or the pooling of interest method. So the main form of acquisition then, or when you are talking of the acquirers, is where I just exchange your shares. They stop being in your name and they become on my name. And instead now I pay for those shares, what they used to call the difference on consolidation or the merger reserve. Well, when you come to the purchase method, we'll still do the merger reserve to acquire the remaining stake. If you are controlling, let's say 70%, we may be interested in the remaining 30. And that's the only way that you are going to adopt the merger reserve. And we'll do this purposely because of, just as an example, to exemplify what we are saying. So the difference on consolidation now becomes a debit balance that used to be written off against the group reserves. That is in the acquirers method. While the merger reserve is a credit balance that is supposed to be shown in the consolidated balance sheet together with the other group reserves. Now we have a question here. I've tried to avoid as much theory as possible. So we have a question here that is a bit comprehensive to mean it has all the forms. So we'll be presenting we have the subsidiary, we have the JV, we have a case of an associate, yeah, and we also have a case of an interest in this same example. So this is the financial position of J Limited, a company quoted in NSE. Then we have K Limited, L Limited, M Limited, and N Limited. They are also listed in NSE. And you've been given the summary of books of account as indicated. So once you get these books, our point of concern is first to look at the goodwill. So we can see the goodwill in the net book value. You can see there is a goodwill of 30 million for K Limited, and we have a goodwill of 20 million for L Limited. So you can see also J has invested in K 75%. So definitely K becomes a subsidiary of J. Then we have investment in L, that is 30%. So 30% means it is an associate between 20 to 50. And then we have investment in M. M is 50, so 50-50, that is a JV. and could be later on in the additional information, we'll see how N is related to the whole thing. So from there, the other area that you are supposed to be concerned is on the ordinary share capital. So we can see the ordinary share capital here. Yeah, they are listed. Apparently, they are trading at the same cost of 10 shillings. So this gives us an easy time. So you have 500, 300, 200, 100, 100. Yeah, then you have some debentures. There is a loan. Then you have K and L. They are having debenture certificates of 15% and 16%. So you'll see how that will affect the merger. So we go to the additional information. So this again, information is very important because of our cost of control account. Remember, it's the first account that you are supposed to prepare before you go to the minority interest to know the extent of control of J in the other prevailing companies. So we go on, we got the additional information. J Limited purchased 75% of the ordinary share capital of K Limited on 1st December 1995, when the balance on the profit and loss account of K Limited was 80 million. So the goodwill in the balance sheet of K Limited arose on 30th November, when K Limited purchased an incorporated business. So this goodwill is being amortized on a straight line basis of over 4 years. Yeah, we should also be keen on that. We know that International Accounting Standard 22, goodwill used to be amortized. But in the IFRS 3, you're supposed to work with the fair market value of the assets, net off all the liabilities, and then of course divide the outcome or the net with the useful life. In this case, is 4 years. Then 2, K Limited purchased 30% of the ordinary share capital of L. We had seen that earlier. So that makes it an associate. So when the balance on the P&L account of L Limited was 90 million, exactly 1 year later, L Limited also purchased an unincorporated business. The goodwill that arose on the purchase is being amortized on a straight line basis for 3 years. So the balance on the P&L of L Limited on 1st December 1995 was 140 million. Then 3, J Limited and another quoted company, Ounga Limited, each bought 50% of the share capital of M Limited. So 50-50. J is getting 50, Ounga 50. So they shared control. This becomes a JV. And Ounga Limited have joint control of M Limited. We are told that. Both companies are to account for the joint venture using proportionate consolidation, combining items on a line-by-line basis. M Limited profit after tax in the year ending 30th November 1997 was 220 million. Then on 31st October, the directors of J Limited issued 32 million ordinary shares of 10 shillings for 48 million shares of. Now this is where now the merger reserve will come in. So you can see that they issued 32 million out of 48 million. Yeah, and they are 10 shillings each. So 480 million minus 320 million. This will now give us the merger reserve. Just before this date, the shares in J Limited were trading at the exchange rate of 60, and the shares of N were trading at 38 shillings. So we have unrealized profit there. So the registrar of companies has given his approval for the merger method. So you can see the examiner has to tell you. Otherwise, you are not supposed to use the merger method. Are we together? It's against the IFRS 3. So included in the stock of J Limited is 12 million worth of good purchase from M, which cost M 8 million. The unrealized profit is to be accounted for accordance with the IAS 31. So that is the UPCS, the unrealized profit of the closing stock. And these goods have been purchased in September 1997. So 30th November 1997, J Limited owns M Limited, 12 million. K Limited owns J Limited, 13 million. And L Limited owns K Limited, 20 million. All the current accounts being the companies, between the companies are in balance. Then no company paid interim dividends in the year ended 30th November 1997. So again, you are going to apportion the dividends. Neither J Limited nor K Limited have yet accounted for dividend receivable. So J doesn't have dividend yet. And then the group considers goodwill on consolidation being impaired at a rate of 20% per annum from the date of acquisition. Then we've been told to prepare the consolidated balance sheet of the group as at 30th November 1997. How do we start? Where do we start? Don't keep quiet. Dennis, how are you? Dennis K, how are you?
I'm fine, sir.
How do we start this thing? Do you have a noisy background? Felix, how do we start? How do we start? Guys, if you keep quiet, it shows that we've not been communicating. I had even to go back to the group accounts to make you people understand these things. You recall? So you say the first step is preparing the cost of control. And here we can see that the holding company is K. So you need to know the cost of control. And this is what will help us now value or revalue the goodwill on acquisition. And if you recall, we said when we were talking about the entries, we said a positive goodwill is supposed to be credited in the cost of control, and we debit the group retained profits. If it is negative, it's supposed to be the opposite. We debit the cost of control, we credit the retained profit accounts. So that should be our first step. Can you be able to get this question from the portal? Are you people able to log in the portal? Because I want to open an Excel sheet. You work from the Excel sheet. I want you to have the copy of the question.
Yes, can.
You can open the notes in the portal. Have you? I can stop sharing my screen, assuming that you've gone to the portal, right? Are you there? Can stop sharing. Kayago, how are you? Kayago. Let me delete this. Was for a different class. And I can just open another sheet. So you need the cost of control account. And there are two. We've seen the case where the K is controlling, no, J is controlling K, and we have also J controlling M, where they are joint ventures. The other one is an associate. We don't need to open a COC account. So this one will be a case where J is controlling K. Have you opened the question? Guys, have you opened the question from your end? Have you opened the question from your end, Fiona?
Yes.
Felix? Felix? Dennis? Ayago, how are you?
Yeah.
You have opened the notes from the portal.
Yes.
Very well. So we go on. We need to start with the cost of control, and we need to know the level of control of J in K. And you have the additional information number one, where we've been told that J Limited purchased 75% of the ordinary share capital of K Limited. That is on 1st December 1995. So if we go to our books of accounts, we can see that the investment in K is 75%, and it is 375. So that should be the figure to be debited here. So we'll talk of investment, let's say J investment. And it is 375. Should have used the, so that I retain this for the amount. So our amount is in millions. What's the figure? What's the figure? What's the figure of J investment in K?
375.
375. So we can say the ordinary shareholding of J in K, our OSC, sorry, supposed to be 75% of this. So what is 75% of? So we are talking about 75% of 375. What do we get? Chap, guys. Time is not on our side. Do we have calculators? What is 0.75 multiplied by 375? From my end, I'm getting 225. Then from there, we need to get the share premium. When we are going through the question, I indicated this. So you can see in the ordinary shares, we have the share premium account.
Excuse me, sir.
Yes?
Excuse me, sir. 70% of this 75, I think
Yes.
is 21.25. 21.25.
It is?
I'm getting 281. 281.25.
281. Oh, it's not
Yes.
supposed to be of 375, sorry. You are supposed to go to the ordinary share capital, which is 300.
Okay.
300, sorry. So that is the stake. If you look at the ordinary share capital, the K stake, the J stake in K is 75%, but the shareholding is 300 million worth of shares. Is it clear? Is it clear?
Yes.
Yes, share premium. We are looking at the share premium. The share premium account for K has 60 million. So it will still be 75%. We are talking of share premium. So this will be 75, should be 75% of 60 million. What are you getting?
45.
45. So we get 45. What else do we want? We need to know the retained profits that you are going to take to the minority interest account. Right? Do you have that information? Whatever is illustrated here is the P&L account. You don't have the retained earnings. But if you look at the additional information, number 1, we've been told J Limited purchased 75% of ordinary share capital on 1st December 1995 when the balance of the profit and loss account was 80 million. So the goodwill in the balance sheet of K arose on 30th November, of course, after the revaluation, when K Limited purchased an incorporated business. This goodwill is being amortized on a straight line basis over 4 years. How do you treat it? We are talking of the retained profits. And this is the figure that will be going to the MI, and the balance will be going to the profit and loss account. What should be the stake? It's still 75% control. And we've been told it's 80 million. So what do we get? It's like 3/4 multiplied by 80, 60.
Yes.
Seems like I'm alone in this class. Then from there, we now need to know the goodwill that was revalued. You are told in the same number 1 that the goodwill in the balance sheet of K Limited arose on 30th November 1995 when K Limited purchased an incorporated business. So if we go up there in the books, we are seeing the goodwill at revaluation was 30 million. And 30 million, that was on 30th November. If you look at the required, we are being told the consolidated balance sheet of the group as at 30th November 1997. So we are talking of from 30th November 1995 to 30th November 1997. So that will be a whole year. We'll have a whole year, 1st December to 30th November 1996. Again, 1st December to 30th November 1997, plus now the revalued for this particular year. So the revalued goodwill been given, it's 30 million. And because you are using the straight line method, and it is 3 years, we'll multiply by 3. So the value of goodwill will be 90 million. So what else do we need in this account? That's all for the J's control in K. So are we getting a positive goodwill or a negative goodwill? We said if it is positive, we debit the cost of control. No, if it's positive, we credit the cost of control, debit the retained profits. But in this case, we seem to have, is it a positive or a negative goodwill? What are the totals?
420.
400 and 420. So our goodwill will be, what's the difference?
45.
45. So this is the figure that we'll be taking to the minority interest account, and subsequently the figure will be going to the retained profits account, the group's retained profit account. Any question? Then from there, we need now to get the COC in M. We need to know the cost of control now of K in the JV. So we again look at the J investment. What's the value?
One 150.
150, right? 150 million. So what's the level of control? So we are looking
50%.
at the M. It's now, if you look at the additional information, I don't know whether we are together with everyone. Number 2 denotes an associate. So for the associate, we don't need to have the cost of control, right? Because we are not owning the majority shares. That's why we have jumped number 2 here in number 3, where we are saying that J Limited and another quoted company, Ounga Limited, each bought 50% of the share capital of M. That is on 31st May 1997. J Limited and Ounga Limited have joint control of M Limited. Both companies are to account for the joint venture using proportionate consolidation, combining items on a line-by-line basis. And you've been told that the profit after tax for the year ending 30th November is 220 million. So it's 50%. 50% of
100.
is 50% of 100. Can you tell us where the 100 is coming from?
Is the value of the ordinary shares of the M.
So the ordinary shares are 200.
M.
No, they are 100, sorry. I was looking at the column L. So it is 100. So that gives us 50. We go on. What's the share premium? The share premium account has 80.
Yes.
Yeah, so we get again 50%. That will give us 40, right? It's half. We look at the P&L. So being told that both companies are to account for the JV using proportionate consolidation, combining items on the line-by-line basis. How do you account for that? Now the ordinary share capital is 100. The share premium, we've accounted 50% is 80. We need the items of the P&L. If you look at the end there, guys, and I don't know what silence means. We've been told that they were valued at 220 million, isn't it? That is the proportionate consolidation. So in our P&L, you're supposed to get that figure. It is 220 million, but it's a JV. So Ounga will take 50 and J will take 50. So we are talking of 50% of that figure. Isn't it? Then whatever we get as the outcome, we get the proportionate, which is 50%. What do we get? So 50% of 220 is giving us 110 million. 110 million multiplied by 50% control will give us 55 millions, right? There is no revaluation of goodwill here, and we need to get that figure. Instead, we've been given the dividends. Are you looking at the proposed dividends? Is it at the end of the period, so they will be paid? They were proposed, but they will be paid. And they were 200. Are you looking at the current liabilities? What is the total proposed dividends? Look at the current liabilities.
$870.
870. Current liabilities. The proposed dividends is after the figure for taxation and creditors. Now we are looking specifically for M. The year 200, isn't it? So we'll talk of the proposed acquired dividends. They are worth 200 million. We again share them between the two joint ventures, 50-50. That will give us 100. And after that, we get now the proportionate, which is again 50%. So that will give us 50. So that will be the cost of joint venture, or that will be the cost of J acquiring M. Where are we balancing at? Where are we balancing at?
$195.
195. So this will give us 45. Guys, you know, when I hear a student that quiet, I fail to understand whether learning is taking place. Felix,
Yes.
do you have a challenge?
Getting the question.
There is a very big challenge with this class. Fiona,
Yes.
I want us to agree. I want us to listen to each other because I want to assist you people. As I indicated from the onset, now this class will involve it involves a lot of work from your end.